Most people think trading is about picking stock direction. But what if you could make money if the stock just doesn't go crazy? You could trade an Iron Condor, and before you say, Michelle, that's confusing, I'm gonna break it down to you super simple. Check it out. An Iron Condor is just a credit spread. So let me go through what credit spreads are. Credit spreads are a way that you can define your risk. You can sell a put credit spread. Let's say the stock is at $100 a share. Well, you sell a put underneath, and then you buy another put underneath that one. So your risk is limited to whatever the difference is between those strikes. So let's say, for example, Apple is trading at $100 and you want to sell a put credit spread. You can sell, let's say, for example, a $90 put, and then you can buy an $87.50 put. And that limits your risk to $250 because that's the difference between the two. Now, when you trade a credit spread, your risk is limited, but your gain obviously is also limited. So no matter what happens, you can only make a maximum amount of premium. But let's keep going through it because it can actually be a really good strategy, and it's super good for people with really small accounts. Now, you can also trade a call credit spread, and it's the same as a put credit spread, but it's on the upside instead of the downside. So for example, you're selling a call here, and then you're buying one higher. An example would be this. The stock is trading at $100. You sell a $120 call, and then you buy a $125 call. If you made a trade like that, your risk is limited to $500 because that would be the difference between the two strikes. Now, an Iron Condor sounds kind of confusing, but it's basically selling a put credit spread and selling a call credit spread at the same time. And here's why you would want to do that. Sometimes stocks are kind of sideways. So they're trading sideways, and as long as they stay within that sideways channel, you make money on both ends, number one. Number two, an advantage of an Iron Condor selling a put credit spread and a call credit spread is this. You can't be wrong about both legs. So in other words, if the stock shoots up, then you're going to win on the put side. And conversely, if the stock drops significantly, you're going to win on the call side. Don't worry, I'm going to walk through an example using my screen and show you click by click. Actually, let's jump right in right now. Alrighty, so we're gonna walk through a couple of scenarios, click by click, and I'm gonna make it super easy for you. So basically, this is a credit spreads calculator, and you can run scenarios on put credit spreads, as we can see here, call credit spreads over here, or an Iron Condor here, which is just a combination of a put credit spread and a call credit spread. Let's start with the put credit spread first. And in this scenario, I'm going to use QQQ. Now, this calculator has the ability to type manual data in, or it has the ability to fetch data via a live feed. I'm always about the easy way, and I want the application to automate as much as possible. So I'm going to show you the live data feed. So we'll start with the put credit spread as I indicated, and I'm going to start with QQQ. Now, the application tells me the current price. Now, I can choose the expiration date here. So QQQ is one of those cool tickers that have daily expiration dates. I'm going to choose something for 2 days away. March 10th would be Tuesday. Now, in a put credit spread, we're selling one put that's underneath the price that the ticker is trading, and then we're buying another put underneath that strike. Now, I get to choose, and our picker here shows us the strike price here, and it shows us also the delta alongside. Now, the delta, as a reminder, that's going to be the statistical likelihood that the ticker is going to drop below that price before the contract expires. So the lower the delta, the more conservative we are. I'm going to start and use a 20 delta. So that means there's only really a 20% likelihood that QQQ is going to drop from nearly $600 where it is now to $583 in the next 2 days. Now, we also get to choose how wide we want our strike prices to be. That's going to be our risk level. So this is saying, okay, do I want to risk $200? Do I want to risk $100? Do I want to risk $500? You get to choose. So I really only want to risk $200 in this scenario. So what I'm doing is I'm selling the 583 put and I'm buying the 581 put, pegging my risk to $200. I'm going to do one contract and I'm going to click calculate. And my application pulls up my data like magic. So this is just showing us the short put at 583. The mid price right now is about 219. And the 581 contract, the mid price is about 185. Now don't worry, because you can actually click in here and you can decrease or increase that price depending on the pricing in the market. Now the application is going to automatically calculate the net credit, and that's the net credit resulting in getting paid premium for the short put and then paying premium for the long put. So this is how much money you end up with in your pocket if you were to make this trade. Now the net credit is going to be our maximum profit. So no matter where the stock goes, let's say the stock shoots to the moon, the most you can make on this trade is $33.50. Now this is also telling us our maximum risk. And the reason why there's a maximum risk when we're selling a credit spread is because we're selling a put, but we're buying another put as protection underneath. So again, the most we can lose is $200, but then we're making $33 on the premium. So the difference is going to be our maximum risk. Now the application is also calculating our rate of return on the contract based on how much capital we have at risk. So if we're risking $166 and we're making $33, we're making about a 20% return for a 2-day trade. Now let's walk through a call credit spread scenario, and we'll use the same ticker, QQQ. Now QQQ is almost $600. So let's look at an approximate 20 delta, similar to what we did on the put side. So I'm just going to scroll down and I'm going to choose the 611 strike. It's about a 21 delta. And I'm going to keep my width at $2, and that puts my maximum risk at 200. And I'm going to click calculate. And again, the application is going to pull up all the results for us automatically. So we would be selling the 611 call and we would be buying the 613 call. And it automatically pulls up these mid prices, but again, we can change those if we want to. Now again, this is a 2-day contract spread with $2, and our net credit in this case is 59 cents. Meaning $59 would get dropped into our account, and our risk here is $141, resulting in a 41% return over the same 2 days. Now we can change this if we'd like. We can make this $3, $4, $5, and we could just recalculate, and it recalculates just like magic. We can also change the strike prices. Like, let's say I wanted to go a little bit more conservative and I wanted to sell the 616 call, and let's say I wanted to risk $4. Well, now I'm only making about a 10% rate of return because this is a much more conservative trade. Now let's hop over to the Iron Condor. I know that sounds confusing, but it's actually just a combination of a put credit spread and a call credit spread. And they're kind of cool trades, again, because if the stock goes up, it won't also go down. So it can only either go up or down, meaning you can't lose on both legs. Let's kind of walk through an example together. Now I just want to show you my screen, and this is kind of where QQQ has been. So you see how we have resistance around 620 and support around 588. It's been in this sideways channel. So I'm going to use those numbers to help me construct the trade. So I'm going to sell the 588 put. Just going to scroll down and select that. And as I said, I'm going to sell the 620 call. And I'm going to keep my risk at $2. $2 on the put side, $2 on the call side, and I'm going to go ahead and calculate. Now, this sort of calculation used to take me a really long time to plug all the numbers in manually into a spreadsheet. And now, instead of taking, let's say, 20 minutes to do a calculation, it literally took me about 2 seconds. Now, this is showing me I'm holding the trade for 2 days. My total credit for all 4 legs is $61. So $61 would get dropped into my account right when I make the trade. Now my maximum risk is $139. And the way we derive that number is that we're risking $2 here and $2 here, but we don't add them together. Again, because if the stock shoots up, it won't also drop down. So we are only risking $200, and then it's offset by the credit that we take in. So our risk is a net amount of $139. Plain English, worst case scenario, the most we can lose on this trade is $139. And plain English, the most we can make on this trade is $61. Now here's how you want to look at this. As long as the stock stays in between 588 and 620, you get to keep the whole thing, $61. Worst case scenario in this trade, you'd lose $139. And let's say the stock breaches 588 by a little bit or 620 by a little bit. Well, that just adjusts your profit. so you might not make the maximum profit. This might sound confusing because learning options is kind of like learning a new language. So it's not something that if you're new at would take like 5 minutes to learn. You have to put a little bit of effort into it. But don't worry, I have lots of videos online. The purpose of this video is to show you a couple of things. Number one, you don't need a lot of money to trade. In this case, I am literally putting up $139 of risk and I'm looking to make 61 bucks and I'm holding the trade for 2 days, very short term. So that's the first premise of this video. And the second premise of this video is that credit spreads are typically a pain in the neck to calculate. Like, what strike do I want to use on the put side? What strike do I want to use on the call side? How much money am I risking? How much money am I making? If you're using spreadsheets, it becomes a very manual and tedious process. But in this application, the computer does all the work for you. So what'd you guys think about that content, huh? I have to tell you, I used to never really trade credit spreads that much because they're kind of a pain in the neck. Like, hey, if I'm doing all that math manually, either with a pen or paper or even a spreadsheet, it's a pain in the neck. It's a lot to keep track of and it's tedious to manually input that. But using the calculator that I just showed you online, can you see yourself doing this in a lot easier way? It makes it super easy, super seamless. And like I said a moment ago, credit spreads are really good for people with very small accounts and perhaps also people that are just starting out, because you don't want to risk a lot of money until you kind of get your feet wet. For example, you can literally trade a credit spread with like $100 of risk. Anyway, I hope this video helps. If you liked it, smash the like button. Be sure to subscribe to the channel. That's it for now. Happy trading.